So in terms of interest rate risk, we have similar issues like last time. Just today we are focusing on bonds and their yields. So practically the problem will be the same, that what happens if we are changing the price of the bond, what is happening if we are focusing on the maturity of the assets, so things like this. But before we start to deal with this one, first of all, this is about the 9th chapter, so we are progressing, so at the end of the day we will reach page 200, and let's see. So practically at the beginning, the chapter is, or the book is talking about interest rates and how relevant they are. So first of all, it says that interest rate risk management is a bit more difficult because we have many different multiple kind of interest rates. So we don't have just one, but practically for each purposes we have at least one. So we can have treasury rates on the bond market, we have interbank lending rates, which is for short-term lending for banks, interbank borrowing, so we practically have also a lending borrowing spread as well. We can have swap rates where we can exchange different practically different things, so from floating to fixed and in different currencies as well. And of course, yeah, so that's also, and also they are not perfectly correlated, so they have usually a strong correlation or practically not just a correlation but a long-term co-movement. So in many cases we can find a linear long-term relationship between them, so they are co-integrated. But in many cases we can find crisis situations when banks were thinking that this relationship is constant and it's not time variant, and this is when they are losing a lot of million US dollars or euros, then they are thinking that between different maturities or between different markets the relationship is constant. So that's why to deal with data exposure, so what is happening if we are the yield is changing or the price of the bond is changing, we have much more complicated work to do, because for each of them we have its own data. So yeah. Also, the other specialty of interest rate risk management is obviously maturity. So we have, for each maturity we have, if we are checking each sub-markets, we have its own maturities for each of them. So practically we have a nice, hopefully positively shaped yield curve. But if we are running a reality check, so we are proceeding with Refinitiv Eikon, and we are focusing on bond markets, government bond markets. Yeah, so we can say that what is completely forgotten from the book. So they are not talking about anything what we were able to see last time or last semester at the International Financial Management, where we were able to build up that, okay, the yield curve should represent what is happening with inflation. Here at least we can see that right now there is an inflationary shock. So this is when we can see that this speed bump is here at the yield curve. So when market players are expecting that the inflation will be temporarily high, and after that this inflation shock will disappear. So that's why we can see that, yeah, compared to the 10% of inflation, the yield in France government bond market is 3%. But after that, if we are focusing on 5-year maturity, it goes down to 2.75%. So there is an assumption that it will go down, but also it should depend on the sovereign spread. So what is the premium paid above the AAA rated euro bonds? So practically above German government bonds. So if we are, can I double this? Yeah. So here we can see that okay, the bumpy thing is here as well. Just if we are focusing on 1 year maturity, then we can see it's 2.8%. In the case of France, it's 3%. So we can see that 0.2% is the sovereign spread in this case. So we have to say that, okay, and the sovereign spread is also changing in time. So it depends on the risk sensitivity or market sentiment about risk. And after that, if it would be a private debt, then that would be a risk premium to compensate the probability of default of the company or the private entity. And after that, if you are comparing the different terms, there will be a term spread. So obviously, participants should, debtors, borrowers should pay also some kind of premium to compensate the investors for using their money on a longer time period. And this is where we can see that this positive steepness is there. Just after that, it's really funny that after 20 years, this steepness is constant. So there is no term premium anymore, and even is decreasing. The reason can be that, okay, here we don't have so much information, and also we can assume that at this time frame, practically the inflation should be around 2% of the designated target of the ECB. So practically you just have to provide some kind of bonus above this, and if you are checking the German, what is this in German? Yeah, but okay, so let's see, 25 years. So it's 2.3, 25 years in 2.3, and here is 3.25. So we can see that there is also sovereign premium, and but they are staying above the long-term expected level of inflation if the central bank is credible enough. So that's why you don't have to avoid or decrease your credibility. So practically we are always using the zero coupon interest rates because in this case everything is compensated for all the options and payments and so on. So the zero coupon yield is absolutely refined and doesn't have any kind of biases or built-in features. So that's why I'm happily using this one. And yeah, and also what matters here a lot, that there is no periodic payment. So it's recomputed that all the interest and principal is paid at the end. So that's why it's easy to use. Okay, and next thing is that there is the challenge of managing net interest incomes, because it can happen that excess of interest received over interest paid. So what can we do if there is a mismatch between received interest and paid interest? Okay, until we are receiving more, it's not a big deal, I think, because we can invest it. So let's bring it to the interbank market, or let's purchase short-term government bonds and we can get rid of the money. So, or at least we can invest this money. If it's in the other direction, then it can be a problem. It can be practically the problem that is visible right now, that if the interest rates on the liability side of the bank is increasing faster than on the asset side, then it can create serious trouble. So this was the reason of the saving banks crisis in the US during the entire 80s, when they were providing long-term loans with nearly 6% of interest rate, while deposit rates and other liability side interest rates were above 12%. And 100 or 1,000 of them, or more than 1,000 of them, went to default. So just each of these banks were not significant at systemic levels, so practically they were just acquired by other banks, so just they were contributing to building bigger banks and for capital concentration. Practically, that's why I have no idea how my bank was providing me a 25-year long fixed interest rate loan. Because I was taking it happily last year when they were saying that, oh, it's 5.6% of interest rate. But for the entire 25 years. Maybe they are not going down. just, just on the liability side, how they were able to do this. Also, they were issuing bonds maybe to finance this. So, but I try to check it, but mostly they have deposit-like instruments. So I have no idea how they are doing this. I should write a paper about that. Usually this is when the fun starts. In this case, I'm motivated to work on that field of interest. So, net interest margin. So in this case, we can calculate the net interest margin when we are taking the net interest incomes to the income producing assets. Yeah, so how efficient we are when we are taking the assets and whatever, how are able to generate revenues. And obviously their fluctuation can be a problem. So what happens? So I can say that there is an asymmetry, just it's really hard to capture it. So what happens if the interest rate increases or interest rate decreases? Because interest rate increases, usually they are fast. So this is always a fast process because some external shocks are building up, like inflation, that there was nowhere and suddenly it's here. Interest rate decreases, they are always much more gradual. So in 2008, okay, short-term interest rates were cut to zero, but it was also quite a slow process. So well, let's go also to the what? Oh, come on. Yeah. So instead of checking this one, financial chart. Yay! So, okay, practically this is right now it's showing the opposite, that Ionia was decreasing, or Euribor was decreasing fast, but this is also not that fast. So we can see that, okay, it was peaked here in October when Lehman Brothers collapsed at 5.2%, and after that it was taking near a year exactly when they were able to reach the lowest point, the 0.4%. So until the next October it was gradually decreasing. And if you are checking the current increase, so in 22 June there was the starting point, and it's still increasing, so we are in March, but yeah, it's less than a year. So, and this size, okay, it's still smaller than the other one. Just here also we can see that this is increasing because practically also Euribor and short-term interest rates are following what is happening at the central bank. So maybe we can see that ECB repo not supportive. Thank you so much. Okay, so whatever, we can imagine that it follows the key policy rate. So let's go back to the slide. And also, we have to be really careful that what is happening at the level of asset liability mismatch. So obviously, depositors are focusing on short run, and in many cases this is revolving. So practically it's renewing again and again. So they are keeping the money there until they are not afraid of the bank or they are not subject of some liquidity shock when they have to use up their free cash. But at the same time, borrowers are using long-term maturities. So, well, yeah, this is called the what is that? maturity transformation. Yes, so this is called the maturity transformation, which is one of the key features of the entire banking system. So the book says that, oh my God, this can be a problem, but also that's why we have banks. So it's nothing new is here, and practically in Basel 3 and 4, they are trying to manage this. So they are trying to motivate the banks to collect longer term maturities, to maintain or to reduce the mismatch also at some levels. But also at the same time, we know that Basel 4 is still not, I think, at the beginning of the semester, it was not released. Yeah, implementation began in this year, sorry. So, but after that, 5 years to fully implement. They are always sabotaging this one. So, but at least they started it. Just the problem is that once they start to build this up and the next crisis arrives, then we are not saved by, or we are not secured by the new Basel rules, because the banks are, or the assets of the banks are already rotten. So. But still, liquidity. So as I mentioned already, that short-term deposits can roll over, and yes, I told that longer-term deposits can be important, and Basel III tries to focus on it, just still not in progress. Okay, but what kind of rates are there available for us? So we have this dandelion again, just it's a different dandelion, but it's blooming us flower parts like treasury rates, repo rates, overnight index swap OIS rates, and libor rates. And also we can find some significant curves or swap rates between them. So first of all, in case of treasury rates, they are the risk-free rates. Yeah, they're supposed to be the risk-free rates. Just the problem is that for many years or for a decade, they were so negative that practically for CAPM modeling or for other purposes, they were completely useless. So again, let's check the reality. But even if we are checking this beautiful French yield curve, we can see that, oh, this part, so until the first year, we have the risk-free rate. But this part is so volatile. So if I'm checking, not Euribor, but French 3 months, yeah, maybe not for daily, but we can have daily. So we can see that it's highly volatile. So sometimes it's going back and forth with nearly 0.5%. So, and also there was negative between 2016 until last year's summer. so in this case we are not able to use this as a benchmark. So compared to the French 10-year government bond yields, and I'm using French government bond yields because at least they were much more positive than the German ones, because that would be even more disgusting. So in the case of the long-term bond yields, at least they are positive. Okay, we can see also volatility. In the past, the literature says, or there was a consensus that short-term bonds are more volatile than the long-term ones, but maybe also quantitative easing kills this rule as well. So because you can see that even for short-term time period, it can be, the volatility can be 1%. Okay, but this time is the Eurozone crisis, so maybe this is not the best part to analyze this. And this is when the quantitative easing started at the ECB, yeah, in 2014. So yeah, so we can see that this is a high But ECB was focusing on, I think, on 7-year bonds. Or no, it was. I think that in some of their, or it was the Japanese central bank. Oh, it was the Japanese central bank which announced that they have also asset purchase program, and they were focusing on maybe 7 to 10 year government bonds, also to have an influence on the longer maturities. But I like it because still at least they were positive, except this period and this 2 years. But this is still negative. So okay, but still better than the short term. And also, what matters a lot, that until countries are issuing bonds in their own currency, and especially in their own currency for domestic investors, then for them it's really hard to go to default, because still for them it's quite easy to force themselves through such a situation. It's not elegant, just it's efficient, what we can say. You know the story when with my friend we are going on different cycling trips, and once we were coming back from Czech Republic, and we had to go through the huge mountains at the Czech-Slovakian border, and there was a 30-kilometer long downhill road. So it was really good. Just once there was this turnaround corner, and I was able to take the turn at 50 kilometers per hour, and my friend just went, so he was not able to follow the curve, but in front of him there was a friendly parking space, and there was no traffic at all, so he was able to slow down and then come back. And okay, I was nearly get a heart attack or something like this when I was able to see that he's yeeting in one direction. So after that we introduced this term that it's not elegant, but it's efficient. That he was able to turn back just with a longer curve. So this is the same thing, that okay, we are saying that in your own currency you can issue as much government bonds as you want, because at least maybe you are just reducing it with inflation. Just okay, but from international finance we know that if we are doing it so many times, then sooner or later there will be a capital flight. So domestic investors will not invest into domestic assets, but still keeping the money in the domestic banking system, or even they are removing themselves from the domestic banking system. And after that you can have this Sub-Saharan Africa relationship, and they have a lot of money abroad as an investment, and after that they have to reborrow it at higher interest rates, and this is why they are struggling with it due to lack of capital. And of course, there can be a problem if you are issuing in foreign currency, because obviously after that you are completely the subject of foreign exchange risk. That's why I'm not happy that our government was issuing. And also the head of the central bank is also not happy, because he worked a lot to reduce the exposure in foreign exchange. And they were changing all the taxation system and everything to push domestic investors at the government bond market. So that's why internal or domestic funding increased from 40% to 60%. So they were efficient. Sometimes not elegant, but efficient. And sometimes there were absolutely no government bonds issued in euros, or there was just some. And it was, so the yield curve in euros for Hungarian public debt was absolutely not interlinked. So you had here and there some in yields, but it was not a continuous thing. But nowadays they were building it back, because they realized that, oh, it's so cheap, and let's take up loans in, let's issue bonds in yen, in yuan, in Swiss franc, and in euro. Okay, and in euro I can understand it, because maybe in the future, in Star Trek years, we will have euro as a currency, but we will not be part of Japan. It would be also funny, just from geological point of view. It's nonsense. Okay, but So this is one feature. The other is the libor. So as a reference rate, libor worked nicely for nearly a century, and we can say that this is short term. Yes, because most of the libors are so maturities are between overnight and 1 year. But sometimes I was able to find maybe longer, but usually they are focusing until or between the range of overnight and 1 year. We can find also libor in different currencies, so that's why it's also really good benchmark. But the problem is that it's unsecured. So first of all, so there are no bonds behind them. But it would be still really good if it would be based on actual lending on the interbank market. Just the problem is that this is not based on lending, because if I'm going forward, so libor is complied by a quotation. So they are taking the most important banks, which are AA rated, and after that they are just asked that, okay, what would be the conditions to borrow funds from other banks or to lend funds to other banks, and they have to give it until a defined timeline, and they are removing the highest lowest quotes or some of them, and after that they are determining it, which was really efficient before the internet and big data. But nowadays this is absolutely outdated, and also there was this scandal of the libor manipulation when this guy was sentenced to prison for 11 years, so maybe that was not the greatest idea. So nowadays they are introducing these other reference rates, which I was talking about it already, I think. So, okay, so there will be new, instead of libor, for each country, they are coming up with their own reference rate. So for the US, it's based on treasury bill covered repos, so this SOFR. Practically, I'm checking always the market, and I was never able to see this, so maybe sooner or later. This SONIA, I was able to see it sometimes, so this is managed by the Bank of England, and this is actual interbank market lending interest rate. So in this case, they are just taking a weighted average. So this is the simplest way. In this case, it's good because it's at least linked to the securities. So it's good because partially you can see interbank market lending or conditions, and also what is happening at the treasury market. So it can be good because repos are always connected to interbank lending and also central bank lending. So it can be also a good indicator. For Eurozone, we have this ESTER, and it's also interbank market deposits, but only the significant ones, because in the case of the US Fed, they have only 20-something partner banks. So this is a really narrow market. For the ECB, they have 2,000 to 3,000 partner banks. So actively 2,000, and the whole European bank market is 3,000 banks. So practically, in this case, they have to narrow it down to remove insignificant players. And for Switzerland, obviously this is not a central bank, because why to harmonize anything? But still we can say that this is a weighted average interbank market, but this is for repo interest rates. For this is not deposits or just lending. It's also funny, some of them is lending, some of it's deposit. This is repo. So it's again, let's connect the interbank market with secured market, so with short-term bonds. And TONA, I was able to find some references also that some people are using it already. It's managed by the Bank of Japan, and we can see that, yeah, money market brokers, just a third one. So the problem is that now everybody was able to come up with new risk-free benchmarks. Just the basis of their calculation and everything is completely different. So at least libor was also some sort of useless, but at least it was defined by the same market, by the same principles, and now it's a mess. So I think that sooner or later someone will come up with again some harmonized thing. Just right now everybody's smart. But what happens here? So practically, we can have this euro, we can have this libor swap zero curve. And what is happening here that we are borrowing money on the short run. So it says that for 3 months they are taking money from someone, from the short end of the yield curve, and after that we are lending it for longer time periods. Yeah, and also the we are not running, or hopefully we are not running any kind of partner risk here, because lenders and borrowers are also AA. Just the problem is that in this case, if you are lending money, then hopefully they will remain in this category. If they are not remaining, then yeah, this is the built-in partner risk. Or also we can say that, okay, in exchange of libor, we just have this swap rate, and it will be quite a boring thing. But the two agenda is the same. Okay, I told about this one. And in the case of overnight index swap markets, practically this is where they are looking for reserve investments. So what happens with banks with excess reserves, which are lending to other banks that need to borrow to meet their reserve requirements? So practically, it's on the interbank market, but this is for really short term. So that's why it's overnight. That you know that from day to day you have to meet the reserve requirements, and sometimes if they are not able to do that, then they have to borrow from other banks to have this, and that's why this Fed funds rate market can be also a useful indicator. So let's check it. OIS for France. Oh, come on, Swiss franc, not Swiss franc. OIS France, no. Then OIS Euro. Yay! So this? No, no. Well, okay, so we have no data about that one, but we can imagine that somewhere in a perfect universe we can find this OIS. Yeah, and also if we can play until we have Libor on the market, that practically what is the difference between non-secured and collateralized lendings. So practically we can also build it on this spread. Okay. If the spread between the non-secured and secured positions or interest rates are increasing, then it means that there is a stress in the banking system. Otherwise, it's... But come on, we need this. Oh, it's not working. Okay, but if we were able to download this, then we were able to see that one. Okay. And yeah, the last thing, Libor versus treasury rates. So treasury rates are supposed to be lower than Libor. Are they? Yeah, so we have the Euribor here, so let's remove this one. And Euribor was, yeah, this one, the orange, and there is this 3 months, 10 months. It doesn't matter. So this one, so before the crisis, short-term rates were obviously lower. Bless you. But if you are checking nowadays, or at least during the last decade, then we can see that this teal, I think it's teal line, then they are really close to each other, and also, yeah, but still the 3 months yield is above. Can I increase it to 1, please? 1 month benchmark? Yes, and still higher. So the book says that practically this number is bigger. Oh, sorry, this number should be smaller than these numbers here, which is nowhere in this universe. But if they would be, then still it says that they are artificially lower than they're supposed to be, because first of all, there is no capital requirement if we are holding treasury bills and bonds. Okay, they are right, because Basel, even Basel II, did not require capital requirement, and also in many cases we can find tax incentives to keep treasury bills and bonds. And also the third thing is that quantitative easing, so asset purchase programs, are artificially pushing them down. But also short-term interest rates, so key policy rates, are pushing also LIBOR down, because interbank markets are also highly limited. So, and if you are checking even the spread by just looking on them, oh, sorry, these two things here, this is nearly, let's say, what is this? 1.3. This one is, so let's say 0.7%. And if we are checking here, minus 0.35. Okay, we can say that the gap is closer, and sometimes they were meeting to each other. Just, yeah, maybe they are, the spread is smaller, but I can't say it's significant. But okay, they know it better. So practically, if we have to define the different things, then we can say that, oh, last thing, repo rates. So obviously repo rates are also secure, or also referred as secured borrowing rates. So it means that I have already the security, so the bond, and I will sell it to another bank, and after that I will buy it back at a defined time period at a defined price, and the price difference of the sales and buyback price will be representing the interest of the loan, and it's securitized, or sorry, it's secured lending, because if I'm not buying it back, then they are keeping the government bonds or the other kind of bond. So that's why it's really efficient, and that's why the European Central Bank also uses this as a key policy rate for overnight, 1 week and 2 week positions, because in this case they don't have to be afraid that what is happening. So they are not running any kind of partner risk except the sovereign risk of the bond, but otherwise it's much more efficient. It's funny actually that how central banks are sometimes jumping between different key policy rates, and sorry, the asset behind the key policy rate. So sometimes we can see that they are focusing on lending rates to the banking system, or to deposit rates, more usually lending rates. In the case of Swiss National Bank, they are focusing on the interbank benchmark rate. I think it was 3 months. It was a long time ago, but yeah, it was 3 months. Sometimes they are focusing on the repo rate, and it can change from time to time. So in the case of the Hungarian National Bank, in every decade they have this different benchmark instrument. So That's why we have to sometimes be really careful if we are building up time series of the key policy rate, because if it's a different instrument, then this is a structural break for us. So. Okay, but now we have the computing part of the journey, because now we have duration. And we can see that what happens with the portfolio if yield curve changes. So practically this is like data kind of risk. So we have the present value of the cash flows paid by the bond, and after that we just have to discount it with the epsilon in English, epsilon, no, gamma. Yeah, this is gamma, but this is this one. Y. Yes, Y. Okay. Yeah, yeah. Just in Hungarian language is epsilon, so.
Epsilon.
Yeah.
In German it's
Yes, yes. Central Europe. So we have always decimal commas and epsilon. And when I was learning, I was trying to learn some Czech, and it was also funny that many Slavic words or Czech-Slovakian words are in Hungarian language as well. So when you have no idea that what is this word or what can be the origin, just we are using it, then it's usually coming from there. Or if when it's really long, then it's coming from German. So yeah. Okay, so practically what we are doing here in case of duration, that we are calculating the weighted average of the times when payments are made and the weight applied to time t, and being equal to the proportion of the bond's total present value provided at cash flow at time t. This looks ugly, so that's why we are checking it with an example. So if you are checking the book, that we have this sample and example, and let's assume that we have a 3-year bond which pays us 10% of coupon, so interest, and face value is 100, and the yield of the bond is 12% per annum with continuous compounding. So the yield is this one, and coupon payments. So it's these $5 are made every 6 months. So practically what happens here is that I'm opening my Excel. Oh, maybe today we don't need Matlab. If I remember, well, we will check also what kind of functions are available, but practically today we would be able to survive without Matlab. So let's define time. It is visible. And so they are saying that every 6 months they have payment. So 0.5 to 1. So until 3 years they are paying some kind of money. And face value is 100, so at the end of the day they are paying this 100, and otherwise, yeah, coupon payments are 5. And of course here we have this 100 plus 5. Payments. So after that, what is the duration here? So this is what we can see, that yeah, also we need a total. Because this is where we will account for the payment, so we can, oh, I left it in, this is Hungarian, yeah. Sorry. But we can sum this up, so practically the same, just we are, instead of shum, we are using sum. So, yeah. Okay, and After that, we just have to calculate the present value of this payment. So it's also quite simple because we just have to say that, okay, what is the present value here? And this is where we need the yield. So let's not confuse that, oh, this is 10% the coupon, but the coupon was only relevant here until the cash flows were defined. After that, yield will be relevant. So this is where some of the students were failing last year. So yield. Okay, and present value. So now we have to say that, okay, this multiplied by exp minus, so this is a present value, multiplied with the time. And then what? Oh my god. What is the name in this case? It's supposed to be exp, not. Oh, they have this stupid name on everything, so that's why I hate Excel. What is the Euler number? Yeah, this number. Then I will make my own exp. Well, practically we are doing the same thing, just with some extra steps. Negative is multiplied with this one, and also we have to fix the F2 here because otherwise it will be tricky. And just after that we can see that what is the present value here, and also let's make it more fancier, so the direction, so we are just using 4 digits. Yeah. So at the end of the day, the present value of the entire cash flows will be 94 US dollars. And after that, we have to see that how much of these payments will be present. Yes, so will be proportional. Yeah, this is when we can use the phrase proportional for these different time periods. So yeah, at the beginning, so let's fix this. Tin, 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 and it's percentage. Yay! So most of the money will flow in, obviously, when it's the face value is repaid, and it should be 100%. Okay, and after that, we just have to take the time to wait, and after that, to be really happy about this. Because this will give us the duration. And now we can see that this is in years, and they are the same. Okay. This will be the next step, but right now let's go back to duration. So practically it gives us that how long the bondholder has to wait for cash flows to come in, and I don't like this one, but but practically this is describing that how patient you have to be. So as a standalone variable, we are not able to use this for many things. After that, if we are adding other variables, then it can be much useful. But if we just have this, it's useless. But if we have a secondary bond, and we would like to decide that, okay, there is a chance to buy this one or that one, the amount of money is the same. But if you can find the lower duration, then practically this is what you should prefer. So that's why it can be useful, because otherwise it's quite useless. And we can have this modified duration where they are saying that, okay, let's do all these calculations, but also we have to modify it with this division. Yeah. And this is when we need the USD duration. So this will be the second part of the previous example, because now we have a bond price at this level, so we can say that, okay, bond price is introduced. And this is this amount of money. And now we can see that, okay, this is duration. So what happens if we are changing? So what happens if the yield of the bond increases by 10 basis points? What will happen with the bond price? So this is much more like for a sensitivity analysis. And this is where we can say that duration behaves like the delta in the case of the conventional assets, non-bond-like assets. Okay, so we can calculate the delta B by just saying that, okay, this sorry, it must be negative. Yeah, otherwise it would be it's strange. And what? Okay, that was a strange noise from a car. Yeah, sorry, okay, so in this case we are still multiplying with the delta epsilon. Yeah, so just I was saying that what is this that I'm describing it here, and after that this will be the same, and then what is the proper purpose here? So practically this is a linear relationship. So this is a negative, in this case it's a negative steepness for a relationship when we can see that, okay, if the bond yield increases, then the bond price increases or changes, then it will affect negatively the yield by this level. So let's say I should add this representation also here. Okay. Can I say multiplication mark? Yes, I can say. Good. Because after that we can just say that, okay, this guy here is 10 basis points. I hate so much when they are saying 10 basis points, because it's not in 100s, it's always in tens. And sometimes we have to convert back and forth, and I can see that, okay, there is 1 0 backwards, forwards, and you can see that, okay, where is the error, and you realize that now it's basis points, so 8. Then the delta B will be, can we say, I cannot say equal here because it will be misinterpreted. Yep. Oh, I was putting so many typos here. Decrease. So at the end of the day, that's why we need this duration, because now we can have the idea that what is the relationship between yields and prices. So duration and so I think this is much more important application maybe than just focusing or comparing two different assets, because here we can see that what happens. And practically, elegantly, I always skip this one, this problem at International Financial Management, because we had always this position as the borrower. So practically, we were selling the bond on the market or issuing it, and after that, who cares what happens? But if we are on the investor side, which sometimes we were, just also it was simplified because it was not at that time in our focus to make it efficient. But here this is relevant for an investor to see that, okay, if the yield curve starts to increase, this one is going up, or maybe it's better, then we can see that, okay, yield curve is increasing, so at the 10-year yields, and we can see that the 10-year is increasing way faster than the short term, which is also not supposed to happen. So the short terms must react on inflation way faster, because the inflation shock. So let's check it. So already we can see that there is this bumpy thing, and if it would be not overly managed by the ECB, then it would be much bigger. So let's check. No. Let's go back. Okay. Asset classes, fixed income bonds, government bonds. Just let's check some more fragile economies. So obviously, Hungary, curve is 0. Yeah. So you can see that the short run. So this is the inverted yield curve when there is an inflationary shock. It reacts fast, and after that, central bank credibility says that, oh, it should be just 8 instead of I don't know which ones. Yeah, there are 16. so this is what's supposed to be also for France. But because they have a fancy ECB and they're inside the Eurozone, then they are not affected by these things. This is the added value of using the Euro. Dear Hungarian politicians. So, yeah. Okay, so I mentioned. Next thing. So, last time we had the delta, and also we had the gamma. That was the other thing. So what happens with large yield changes? And weighted average of the square of the time of the receipt of cash flows. So obviously, also you can remember from last time at the end of the lecture part, I was talking about the Taylor expression when it was like that if you're analyzing changes, then okay, everything on level, then on squares and on third and so on. So it was like this, how you can describe a curve, the nature thingy, and it's always that it will not just on second, but it can be on third and so on. So this is also building up the same structure here. So yeah, we have to estimate this one. And yeah, so this is what we should describe, which looks ugly. But I think that there was convexity, yeah, here as well. So practically we know all the things here now. So we have the bond price, we have the duration, but what is the convexity? So how can we calculate this? Because this kind of equation, what we were able to see here, this one doesn't look so ugly. Just what is the this one? What is the practical application here and relationship between them? So we have the duration, and practically what we need here, yeah, okay, I already copied the equation. What we need here is to express all these things. So to describe this squared relationship between time and payments. So yeah, time is here and payments are already in the weights. So practically we need a C. And after that just we have to say that okay, this one multiplies this thing on squares. Tip, 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 tip. And after that we have to sum this up. What? Why not? 0.05. No, I'm so stupid. No, I was doing the wrong thing. Yeah, the weights and the time, and practically what I was doing here. Yeah, the time is on squares. But I am not. Okay, so this is. Is supposed to be the D6 and this is the G6. So I was doing the opposite. And yeah, because this one is all the square of the yield changes, and after that just we have to say that okay, if the price of the asset will change a lot, this price or the asset is bond, then we just have to say that okay, this negative number, the duration multiplied by the delta of the yield, so we have this number here, plus the C. Where is the, which one is the C? Yeah, this one is the C, yeah. Multiplied by, but who are you? This is supposed to be here, this is supposed to here. Hopefully this is just a typo, because yeah, this is not okay, let's see. This one square, so this one 2% is change. Okay, then I have to change my references. So let's say second. Then what are they doing? I mean, what kind of thing is this one? So bond price, but it was not in the equation. So bond price was here. I'm a bit confused here. Because, okay, that was the original. Just, in this case, we should add this. So this is, let's create an alternate version of this before I'm overwriting everything. So B, this is B. This is the duration. So okay, duration is coming back. This is the change. Okay, we were adding this one. And after that, 0.5. So time. So we need a T, because after that everything is nicely done. So we can say that okay, this is a B. I think that there should be a 0 or a point, because otherwise this is not working at all. And so that's the convexity, and after that we have the square of the change here. So now we have a proper equation. So let's remove this one, because now we can cook with that. Or yeah, this is my bad, because here is B. And if we are just saying that okay, let's focus at what is happening, then we just have to multiply. That's why. Okay. So delta B. Delta B here. And let's say that here we need also the delta B. Sorry, not the delta B, the bond price. Okay. So we have the negative B, the duration, which is this one. Yeah. The second epsilon is there. Yeah, we are adding it 2 times, so let's move both of them. And after that, still here we need the B, because we have to multiply it to get this done. But I still cannot understand that where T is coming from, because T steps are done here. It can be the reason, because the rest I can understand. Just that one is quite an exotic. But okay, you can see that the B will change in this way. So let's give nice calming orange color to that one. Yeah. So if you would set the same thing, yeah, it's still valid. I don't like when they are changing something within the same example. Okay, so I will bring you back to your place. And there is also note. Okay, we are creating a derivative or derivating here. Where this guy is coming from, I don't know. But whatever. So yeah. Okay, so after that there can be a generalization where they are refining all the equations. So for portfolios, obviously we have to create weights for all the assets. So this is, I think, nothing special here what we can see. That just we have to have this multiple set of tables, not just one. And after that, what matters a lot that we can calculate the weighted average of durations. So it's not like when we have to calculate the standard deviation or volatility of the portfolio when we have all the interactions between them, covariance variances. In this case, we just have to create, it's like the return of a portfolio, the weighted average, and that's all. So we don't have to be afraid that what is the interaction between them, which is also strange because we know that if they are co-integrated, they're supposed to be something. Just it's not a variance-covariance relationship because that would be short run, but it's a long run. So this is supposed to be a linear transformation, which is describing the underlying relationship, which can be expressed with a vector error correction method with the main equation, and after that we could build this thing up. But they are not doing it, so we can sleep well. And this is where we can find, maybe we should read less next time the book when this is not time related. This is just saying that convexity is
Diversity.
Okay. But here it's also a problem because if you are looking on it, yeah, there is a p. Okay, it's also no problem because if you are multiplying, then still we get the same thing. So let's go back here and so this is not a variable. This is independent. So this is part of the equation. Okay, cool. And until then, I was always skipping that part with my eyes, so it was okay, it's there, but I was always focusing on what is happening here. So, portfolio immunization at the end of the day, so we have to take long and short positions in interest rate dependent assets, and in this case we can be protected against relatively small parallel shifts in the yield curve. That's why we have to maintain a portfolio where the duration is zero. That practically we have to buy and sell assets to create portfolio until we can say that the weighted portfolio duration will be zero, and also to maintain or to avoid large parallel shifts in the yield curve, then we have to create a portfolio where the convexity is also zero. So okay, good luck with that. And I think that, yeah, there was no rotation. Because the book starts to talk about this one, but I think this is not for today. Yeah, yeah, because we are ending here and not going forward. Okay, so that's all for today. Shall we check what happens in MATLAB? Because, so let's say duration. So if we are setting the yield to 12, coupon rate to 0.10, settle. Now we don't need to convert time date. Now it's perfectly happy as it is. Very odd. We are setting it to 2, so it's paid twice. Base is supposed to be 0. And this will provide us, yes, this is the good number. So year duration will be this one. So let's not delete this one because otherwise it was a nice duration. Just it was much more sophisticated what the book was describing us. So because 0 rates are allowed to change. So practically here we have an entire yield curve. Here we just have this simple solution. So, yeah, and after that we can still say that, okay, what is the application here? So we need the bond price. So we can say that, okay, let's set the bond price to this number here. Then what will be the, yeah, and also we need the change. The year change will be 0.001, so 1 basis points. So what was that, 10 basis points? Yeah, 1 basis point, okay, I remember well. And then data bond price will be we have to take these numbers, so bond price multiplied by the year duration and after that multiplied by the year change. Yeah. And this is what we have here. So it's also funny that this is not the same. From the same inputs. And there are no roundings. So everybody uses the same inputs and because this is supposed to be okay, let's say that, okay, just, or maybe just still a rounding error, just I was not, no. But the exponential will come later. This is, where did I, no, this is where where is the exponential? Yes, you are right. You are when I calculated the present value. But in this case, the year duration must be flowed. Yeah, the last two digits are. You're right. Okay, cool. Because I was focusing on the first three, and then I did not check it. Okay, so data can be calculated this way. Then let's check convexity. So do we have bond convexity at given yield? Okay, we have to use this one. We're creating so many fancy. Practically, we could calculate it easily without functions, but if they have fancy functions, then why not? So we have yield, we have coupon rate. Practically we have already this thing, so we don't need to overwrite it. Settle maturity. Then let's go ahead and check here. Convexity, so 7.9. It's familiar. Oh. What happened with you, my dear? Or now, yeah, the squares are increasing. Yeah. So the errors are rounding errors are happening. So now we can pick up this one, and we can say that let's continue this. So still the same change will be there, just okay, so minus something. Bond price multiplied by okay, let's take the function, so multiplied by the duration. So year duration, and then the delta, so the year change plus, this is not t, this is 0.5, and then the b, so the bond price again, multiplied by the convexity, and then you change on squares. Yay! And negative, and practically still it's quite the same, so just one digit, so it's cool. So practically, if you are lazy, just in this case, I think that Excel can be more efficient, because here I cannot see the added value. So maybe if we are running for some kind of sensitivity analysis, then maybe it's worth the work. So if you would like to have something like that, okay, what is happening if we are increasing the yield from 1 to 10? So this is increasing by I, and there will be the delta price. Just to have some practical application. Bing. And now we can see that what is the relationship between the different level of yield increases and the different level of price decreases, and we can see that I think this is completely linear. I cannot see that this would be curvy, so let's see that. Yep. No, it's curvy. Yeah, because due to the square, it should be, yeah, just 1000. And let's now we need all the closures for the end of the lines. Yes, okay, this is a nice parallel. Just maybe this is the real part, and after that it's overflowing because now it's ridiculously high. So yield change is 1. So 100 doesn't have a meaning anymore, so maybe it's only reasonable to deal with 100 here because we are going up to 90%. Until 90%, I think it's reasonable to go. So delta price. Let's not overshoot. So in this case, we can see that, oh, it's decreasing in terms of price, and after that it's increasing. Okay. So that was for today.